Hello, guys. What's going on? It is Thursday, September 18th. I went out to the range today. It's been a few weeks. Got to keep the skills up. You never know. All right, so we had a positive day in the market today. Gold was down. Dollar, I think kind of flat. I don't know. I didn't really look. Bonds were down, yields were up, as I said was going to happen. But this is a gift on a silver platter. I keep telling you that. I said Powell was going to squash any enthusiasm about more rate cuts at the meeting yesterday. It's exactly what he did. I said rates could pop back up to around 415. They could even go as high as 425. They could even go a little bit above 425. But now the policy range is 4 to 4.25. So that's your band right in there. We get down below 4%. We can get all the way back up to 4.25, slightly above. Somebody commented on the day when the Fed had the meeting on Wednesday, like, Mike, you said rates were going to pop up. What happened? I mean, you guys crack me up sometimes. If I say something and then it doesn't happen lickety split on an instant, it's like, what happened? I don't know. Like, I don't know how old you are. Maybe it's me that I'm older. I have more patience. You know, with age comes a little bit of seasoning. Like, I've been through a lot of stuff. You got to calm down. This is where I said it was going to go. And I said it's a gift. When you get this bounce back in yields, when bonds go down, you buy. We are now, if you look at what the Fed said yesterday in its forward outlook, that by 2027, I know that seems like a very long time away, and it is, but the market reflects what Fed policy is going to be over the term, meaning over that duration of time. If they're forecasting this, and we don't know, it's true, like other things can pop up in that interim of time that could change that outlook. But right now, if that is the outlook, that is going to be reflected in bond yields. So we're going to trend lower on bond yields. I don't know how many times I have to explain this. Bond yields are nothing more than expectations of Fed policy over the term, over the duration, whatever you're talking about. 2 years, 5 years, 1 year. All right? So when you see yields popping back up, and when you see treasuries selling off, you take that as an opportunity to buy treasuries. Now, I've been telling people to use, I'm not a big fan necessarily of these ETFs, you know, but that is a way you can participate in this move. You have like the TLT, you have IEF, those are two examples of ETFs that are based on treasuries. The TLT are the longer dated. The IEF, that ETF has the 7 to 10 year, the mid dated. I prefer bank stocks. I've been saying that. The big banks are holding record positions in treasuries, and a rally in bonds is going to do two things. Number one, their profits are going to go up as a consequence of better performance in their trading profits. Okay, they call that trading profits. They hold positions. Number two, because they have a large holding of treasuries as their tier one capital, their capital is going to go up. So the value of those companies is going to go up. It's like if your net worth goes from 100,000 to 200,000, or 100,000 to 500,000, if your net worth increases, your value, at least financially speaking, has gone up. So I prefer to play the treasury market by owning bank stocks. I own JP Morgan, all the big ones, JP Morgan, Citi, Wells Fargo, Bank of America, Capital One, Ally. That's a very clean and easy way. Plus you get dividends, okay? This is not so hard. Like I always tell you guys, we are so lucky. You don't understand. Like we are so lucky to have the stock market at our disposal and to be able to freely invest in that. Like I hear a lot of people comment sometimes whining and bitching and complaining about life, that, inflation or whatever. And I get that. Like, look, not everybody has a lot of money. But if you start early, and I started late, let me tell you something. I started late. I spent most of my younger years and even midlife years trading in futures markets. I was a member of 4 exchanges, doing what I think a lot of you guys think is such a cool and great way to make a living. In and out, buy, sell, buy, sell. It's not. It's not. There's not one hedge fund guy who can even come close to what Warren Buffett has achieved by just buying and holding stocks over a long period of time. And that even includes guys like Ken Griffin of Citadel. I finally remembered this guy's name because every time I talk about this guy, or every time I want to mention him as an example, his name never comes into my head because he's not important to me. But like I finally remember his name. His whole firm, Citadel, is like legal front running of orders, okay? Insider trading, which he's allowed to do, all right? And he's not even close to Warren Buffett. And you're thinking like, you're gonna do this and you're gonna beat a guy like Ken Griffin, who has spent tens of millions, if not hundreds of millions of dollars to put his computers, his servers at the New York Stock Exchange and the Chicago Mercantile's data center out there in Illinois, so that you're talking light speed, nanoseconds, seeing the order flow come from TD Ameritrade and Schwab and Vanguard. He buys the order flow. Okay, that's why you don't pay commissions anymore if you have a stockbroker like Schwab or TD Ameritrade. Why did that happen? That there's no more commissions? Because these guys get paid by Citadel and guys like him, like I'll call him my friend, but he's not really my friend. He's an acquaintance. I knew him, Vincent Viola, who he founded Virtue Financial, which is another one of these algo shops. That's what they do. You can't beat them. And you shouldn't even be in the game to try unless your motive is excitement, is the dopamine rush of doing that and sitting in front of a screen all day long and watching tick, tick, tick and CNBC and Fox Business and somebody just said something, I'm going to jump in. I go to the range or I go fishing. Okay? But what I was starting to say was like, we have this wonderful, wonderful thing called the stock market that even if you could just put a little money into it, and I'm not saying, I understand that some of you, it's not gonna completely offset maybe some of the hardships that you have to deal with in terms of higher prices and stuff like that. But my attitude is do something. Do something. This is what I'm all about. And I teach this to my kids. We're all going to be at one point or another in our lives, I guess, I don't know, to use the lack of a better term, like victims of something or feel that there is an injustice visited upon us that we didn't ask for. Everyone's going to have that happen to some degree in their lives, okay? Money is a tiny little, there could be terrible, terrible things that could happen. Look at the family now of the wife and the kids of Charlie Kirk, he's gone. I mean, things like that. Or what happened to the hostages in Gaza, and there could be really terrible things that can happen to you, which make, the loss or the lack of money, it just pales in comparison. Like, you got to put life in perspective. As bad as you think things are for you financially or stress, and I've been through it. I've lost businesses, I've lost things, and had to start from scratch, had to start from zero, and I remember nights where I couldn't fall asleep, and the stress and the anxiety. But do something rather than just, oh, poor me, the system is against me. Yeah, it is, okay? That's reality. I don't make policy. I'm not an insider. I just do what I can do. But I do something. Take advantage of it. I make these videos. I talk about this stuff. I try to educate you on these videos. If you don't like it, or, if you're a cynic, and then you just want to bash it because you feel miserable, that's a bad attitude. That is a bad attitude, to be cynical. That's just what that does mentally for you, emotionally for you, is just digs a hole for yourself mentally and emotionally. You put yourself in there, and you put like a trap door over that hole, and you lock it, and you keep yourself in there. When you have the key in your hand, that you could at least get out of that hole and do something. Anyway, I got off on a tangent there. So, the AAII survey today, very interesting. A big jump in bullish sentiment. Remember, I've been telling you that sentiment was such that we're gonna see a market rally, because there was very low percentage of bulls, very high percentage of bears. I said that's a condition, especially we're coming into a rate cut, and you got 7.5 trillion in flows, and we got 2 weeks left in the fiscal year. Okay, where we're running like what, 700 billion a month. So running like 200, what was that? Almost 200 billion a week. Okay, a little bit less than 200 billion a week, because we're running like 720 billion a month. So we're going to see almost 8 trillion. But when all is said and done, this fiscal year is going to be the largest leading flow. It even beats out the COVID years, the COVID stimulus years. So what happened, I was starting to say, what happened with the AAII is in the last week, there was a big jump up in bullish sentiment by individual investors. Okay, now that's a little bit of a caution sign, at least in the short term. But bearish sentiment is still higher than the historical average. So we're not going to see a top in this market, at least a tradable top, until bearish sentiment comes way down below the historical average. All right? So we're in this moment now where I think we're looking at some kind of a wild blow-off top. And when I say top, I don't mean that's the top for all time. That's never going to happen, because the stock market is a growth function. But I mean something that might have the underpinning of a slowdown in fiscal flows, maybe later this year or next year, when we really start to see the impact of the tariffs and the rate cuts as they start to remove more and more income from the economy. I almost think like gold could be like a barometer of this. You saw it was down today. That's the thing we got to focus on. The tariffs and the rate cuts now, the resumption of the rate cuts, because I told you, like already T-bill interest is down 42 billion compared to last year. Interest income transfers are still up, but that's because of interest on Treasury securities, the longer dated Treasury securities. But we got to pay attention to this because this is going to be an increase in fiscal drag combined with the tariffs, which is another increase in fiscal drag. If you have a condition like that, which starts to develop later this year, you know, we only have like 3 more months left in the year, or next year, then the market will suffer for a period of time because we will have a contraction in the economy. I'm not saying I'm 100% certain on this because as I always say, as I always qualify, I watch the flows. It tells me. My instruments, right? Flying the plane, the mariner out on the open sea. I let the data tell me and I see it every single day. So I know, I track it, I follow it. It's like, that's my GPS, that's my guidance system. Okay? And it's not gonna send me off in the wrong direction. It shows me exactly what is flowing into the economy. And it's all about that. It's about income transferred in and income drained out. On balance, what's happening? The swimming pool, right? Are you adding water or are you draining water? Very simple. That's how it is. Anyway, that's it for today, folks. Thank you for watching. I appreciate it. Please like and subscribe. And don't forget, go to my website, sign up for a 30-day free trial to MMT Trader. See you tomorrow. Bye.